Now let's get more on how geopolitical risk is playing into monetary policy and then into investor strategy. Mark Haefele, UBS Global Wealth Management Chief Investment Officer, is joining us now. Mark, as you take a look specifically at Europe, which is the situation we were just discussing with Caroline, obviously there is a much heavier economics reliance on Russia and on Russian energy in particular. Goldman Sachs, Bank of America, a number of firms now coming out downgrading their outlook for Europe for that very reason. How comfortable are you putting money into Europe right now?
Well, we are doing a lot of relative value trades. And so one way to play into Europe, for example, would be overweight European equities versus Swiss equities. The growth in Europe as they come out of COVID should be strong if we can get through this crisis.
Yeah, Mark, this is not going to be a 1 or 2 day crisis. It's not going to be a 1 or 2 week crisis by most analysts' estimations. We're now looking at gains of more than 3% on European markets. For many, that will leave them scratching their heads as to the pricing of geopolitical risk.
Well, yes, look, I mean, as we watch this tragedy unfold, for people around the world to then see the market reaction, it's terrible in a way, and the markets are not, they're amoral, and we have to contend with that. But keep in mind, there has been a lot of risk that was priced in as the tensions ratcheted up, and very often when you get the conflict released, then the markets do have this kind of a snapback. But I agree with you that in some ways it's too early to predict how this is going to play out. And that's why, where we're taking risk in equities, we are trying to take it in those areas where there's multiple ways to win. For example, commodities and energy, where we can benefit in a sense from the heightened commodity prices that may result from this crisis, right, or if there are heightened commodities as we get this recovery.
Well, Mark, it's an excellent point, and one, as we sit here and monitor the markets, which we will continue to do so here on Bloomberg Television, there is always a human cost to war, and we have to keep that in mind. But one of those costs, while not necessarily the same as the people in Ukraine are facing, but potentially consumers in Europe could face, is those higher energy prices, some of those inflationary forces. How do you think this changes the calculus for the ECB and other central banks?
Well, what we've seen in all of this is that the only thing stopping President Putin is not the sanctions, but it's President Putin at this point, because the difficulty in occupying the largest country in Europe, for example. And the reason that's the case is the reluctance to take sanctions that harm European consumers and European economies more than they harm Russia. And so, that tension is going to exist, and how much of that plays out in the monetary space, I think, remains to be seen. For us, the key factor is that if we do start to see those base effects coming through and the inflation starting to come down, maybe perhaps in the United States in the next 2 months or so, then policymakers do have a little bit more flexibility when they're dealing with this inflation issue.
Where is the vulnerability for earnings at this point, Mark?
So when we look at this crisis, if oil was to stay above $125 a barrel for several months, then you start eating into global growth. And that's when you'll really start to see it in what have been very strong earnings, particularly nominal earnings, right?
And Mark, when we're talking about earnings, what has consistently been an earnings growth story has been technology, has been some of those growth equities for obvious reasons. Can they act as a haven in this kind of environment, or is the risk of higher rates too great for that sector or that group of stocks to be an outperformer here?
Yeah, we would not be betting on the growth names at this point. We would prefer to be betting on the cyclicals. Because of that rate picture, we think that can impact them. And we think that the growth is going to be very strong in the first half of the year. And so this is the time for value and cyclicals as these rate hikes are getting underway. But later, when growth becomes more scarce, that's a time to return to those high quality growth names.
And Mark, you've raised your target for the US 10-year from 2.1 to 2.3%. What is the read across to the US dollar?
We think that the US dollar is going to be strong. Now, it's been a great way for us to express our views because, of course, it's been a safe haven trade. But we think that because the United States will be hiking those rates and that path is much more certain, at least at the outset, than it is in other parts of the world, as those interest rates rise, that will attract the capital into the United States, and that will help keep the dollar strong.
Mark, if a client comes to you and says, I'm thinking about going to cash, what do you tell them?
Well, first, we really say, look, you've got to have a plan where that includes things like this, and you have a certain amount of liquidity, whatever you may need for a period of time, be it a year or 2 years. And that means when you do that, when you operate from that mindset, in these kind of markets, you can be looking for opportunities rather than acting out of fear. And so we would definitely tell clients not to be moving to cash now if they have a plan, and that there are opportunities. There are opportunities in these cyclical names. There are opportunities in select areas of tech like cyber technology, which we hear about. And of course, energy independence is the theme for the next decade.
Mark, do you like China at this point?
For us, in the context of Asia, what we're seeing in China now as they add more stimulus, as they work through some of these regulatory issues, we prefer China to other parts of the Asian equity markets. We think that the growth there is going to pick up.